Hello everyone, welcome to EduTap. So in today's session, we are going to discuss about the components of the budget receipts versus the components of the budget expenditure. See, budget receipts includes the revenue receipts and the capital receipts, and the budget expenditure include the revenue expenditure and the capital expenditure. This is a very important topic and I will show you that why this topic is very important. Okay, but before that, please subscribe to our YouTube channel if you are new to the channel and join our Telegram channel for the PDF of this session. And you can get the link of the Telegram channel in the description box below. So here is the question, previous year question of RBI Grade B 2021 that shows that this topic is very important because a direct question was asked that which of the following is a revenue expenditure, and revenue expenditure is a part of budget expenditure. This question you will surely be able to answer by the end of the session. So now here is the structure of government budget. Okay, but before that, let's understand all of this with a simple example. See, this, understand that this is you. Okay, take it as you are this person and you are earning something, some income you are earning, or you are taking some loan. That is also something that you are receiving. Or you are selling your assets, you are selling your building, your property. Through that also you are gaining some money. Okay. Now this money that you have gained, you will spend somewhere also. Maybe you will buy clothes. Maybe you will spend on buying the gadgets or something. Or maybe you will buy the shoes. So you are also spending somewhere. Similarly, government also takes some receipts. It have some money that comes from different sources, like taxes it gets, the money it gets from the loans or the grants. It also spends at different places, like it makes the public infrastructure like schools, like education institutions, hospitals. So it is also spending somewhere. So that is what the budget receipts and the budget expenditure is. Okay, budget receipts tells you that from where the money is coming to the government, the different sources, and budget expenditure tells you that where the money is going from the government, where the money is placed by the government. So budget receipts include the revenue receipts and the capital receipts, while the budget expenditure includes the revenue expenditure and the capital expenditure. Now I will tell you that what this is: revenue receipts and capital receipts and expenditure, expenditure and capital expenditure. So now first we will see the budget receipts, that where the money is coming to the government from different sources. So see, for this you need to understand the assets and liabilities. You will easily understand the difference between the revenue receipts and the capital receipts, or what they actually are, by understanding the assets and the liabilities. See, assets is something that you own, like the property that you have, a building that you have, okay, a company that you have, that is your assets. Liabilities is something that you have taken some money maybe and you have to return it. That is your liability because you have to return it. So in the case of revenue receipts, it neither decreases the assets or nor it increases the liabilities of the government. Okay, in the case of revenue receipts, it is not decreasing the assets of the government or not it increases the liabilities of the government. In the case of capital receipts, what is happening? It is decreasing the assets of the government and it is increasing the liabilities of the government. Now you will understand this more clearly by this picture, we can say, and understanding this all. So revenue receipts, see, in the case of revenue receipts, you get the tax, the government gets the tax revenue and the non-tax revenue. Okay, this is how the government is getting money in the revenue receipts case. So in the tax revenue comes the direct tax and the indirect tax. Direct tax like the income tax, wealth tax, that the government directly gets from the people. Indirect tax is like GST, that is imposed on the goods and services. Okay, so the government is getting the tax revenue, the money from the tax revenue, and tax revenue, is it reducing the assets of the government? No, it is not reducing any asset from the government because the government is getting this money from the people. So no asset is being reduced. Is it increasing the liability? No, because the government do not have to give this money that it gets from the tax. Okay, so it is not even increasing the liability because the government do not have to return the money. So now we come to the non-tax revenue of the revenue receipts. See, interest receipts, the government has given some loan and it is continuously getting the interest. Is it decreasing the assets? No. Is it increasing the liability? No. It is the interest payments that is continuously the government is getting because it has given some loans before, some years before maybe. Profits and dividends, the profits that it is getting from the public sector undertakings, that is, we can say the BHADE, or through railways or through different public sector undertakings of the government. The government is getting the profits and dividends regularly. Through that also the government gets the money. From the fees and fines, we are breaking the traffic rules and we are giving the fines. Maybe we are filling the forms of the RBI Grade B and that's why we are giving the fees for that. External grants, maybe some other organization, maybe some external organization is giving money to the government of our country as a gift, as a donation. That is the external grant that we are getting. So it is not decreasing the assets of our country, neither is it increasing the liability, because we do not have to give back the gifts or donations. Okay, so this is what the tax revenue and non-tax revenue are, which is not decreasing our assets, the assets of the country, and which is not increasing the liability. Okay, so now we come to the capital receipts. See, recovery of the loans. We have given loans to someone and that is our asset. Okay, if I am giving 1 lakh to someone, that is my asset because I am earning something on it. Okay, I owe that money, that is my money, and I am earning some profits on it. So if I recover that loan back, if I take this asset back from the person, so now that is the recovery of loan and that is decreasing my assets because I am taking the money back and now I will not get the profit on that money. Okay, so it is decreasing my assets which would have earned me interest in the future. So recovery of loans decreases the assets because I have taken the money back. Disinvestment, you are selling your PSUs, the government is selling the public sector undertakings, or it is selling the land that the government owns or something. So it is disinvesting. So it is decreasing the assets. It is taking the borrowings, that is, it is increasing the liability because the borrowings, the loan that we take, we have to give back, right? So provident funds. See, provident funds are the PFs that generally all the government employees, most of the government employees have. Okay, this is the money of that employee which is kept with the government and the government has to return it back. That's why it is a liability. The provident funds is the liability which the government has to give back. So I hope you have understood the receipts, that is the revenue receipts and the capital receipts. In the case of the revenue receipts, no asset is decreased or no liability is being increased. While in the capital receipts case, the assets are being decreased and the liabilities are being increased. See, revenue receipts are of recurring nature. That is, it keeps on happening every month. The taxes are being the taxes the government get on a periodical basis, on a recurring basis. Okay, but and interest receipts also, they get every month, maybe every 2 months maybe. So it is a periodical system. But here the capital receipts, it is non-recurring. Okay, it is not recurring, that is, it is non-recurring in nature. That is, it is not happening periodically. It is not like the government will send the disinvest every month. It can happen anytime. So it is non-recurring in nature. Now we come to the expenditure, budget expenditure, that how the government is spending the money that it has got. So it can be revenue expenditure, in which case assets are not created, neither the liabilities are being reduced. Okay, you are not reducing the liability, you are not creating the asset. In the case of capital expenditure, either you are increasing the assets, either you are creating the assets, or you are decreasing the liabilities. So here you can understand this with the example that payment of interest. When you are giving the interest because you have taken some loan, so it is not increasing your assets. Okay, it is not increasing your asset or it is not decreasing the liability because the loan is still there. You are just paying the interest, the extra money on that. Payment of salaries and pensions, no asset is being created, no liability is being reduced. You are just paying the salaries of the people that are working for the government. Grants and subsidies, you are giving the subsidies to the people, but no asset is being created, no liability is being reduced. Education and health services, the teachers there are, the doctors that are providing the services, you are just paying for their services. You are not creating an asset or you are not reducing the liability. Similarly for the defense services. But in the case of the capital expenditure, you are increasing the assets. You are constructing the roads and bridges and buildings. You are purchasing the land and machinery, that is increasing the assets. Investment in shares, of course your assets are being increased. Loans to states and foreign government, you are giving the loan. Loan is the asset for you, so you are increasing the asset. Repayment of loans, that is you are decreasing the liability. Liability is something that you have to return, and so you are repaying the loans, that is you are decreasing your liability. I hope you have understood the expenditure also. Very easy, I must say, and you will understand it better with the difference when I will show you. So revenue expenditure is the expenditure for the normal running of the government departments and the maintenance of the departments. Okay, you are giving the salaries, you are giving the pensions and all. So it is normal running of the government departments. But here the capital expenditure is for the acquisition of the capital assets. When you are getting the capital assets, okay, or you are reducing the liability of the country. Okay, maybe the India has taken so much money from the IMF or from the World Bank, so we are repaying our debt. So that is reducing the liability of our country. It is recurring in nature. Of course, every month you have to give the salary. So it is recurring in nature. It is periodical. And it is incurred regularly. The depreciation that is happening in the departments, that also you have to pay for. Okay. It is non-recurring in nature. It is not periodical. Anytime the government feels like the roads are being needed in the country, they will start making the roads. So it is non-recurring in nature. It doesn't happen all the time. Okay. Next is, it is called non-developmental expenditures because you are not directly creating something. You are not directly creating the assets. So it is considered non-development expenditure. While here it is considered development expenditure because you are creating the assets. Okay, or you are reducing the liabilities. So you are benefiting, you are developing the country by making the infrastructure and all. So it produces benefits over several years. That road will be used for several years in the future. So it will benefit for several years. So I hope you have understood the receipts and the expenditure and the differences between the receipts and the expenditure also. Receipt is something the government is getting, and the expenditure is the government, what the government is spending. So I hope you can easily answer this question now. This is your homework question. Next is, which of the following is not a part of the revenue receipt? I hope you can also answer this question. It is also a very easy question. So this is also your homework question. Now there are the name of the people that have answered the previous question of the previous video, right? And I'm really happy that you all are, most of you are understanding the concept. See, economics is something you cannot cram. You have to understand the linkage, okay? So it can be very confusing, I know, but Sajad, Ankush, Amit, Geeta and Keshav and Jatin were the people that gave the right answers, and it was really good. Even Jatin explains the whole thing, like why he's giving the answer. So now I will tell you, like in the second question, many people gave the wrong answer. So I think you got confused a little. The balance on current account includes all of the following items except some people answered E, but C. D should be the answer. Okay, why D? Because this is included in the current account, and we are asking what is not included in the current account. Why is income receipt included in the current account? See, the current account includes all the things that are not creating any asset or the liability. So the income receipts, are they creating any asset or are they creating any liability? No. If we are talking about the investment, here we are not talking about the investment. Here we are talking about the income receipts that we are getting from the investment. So investment should be go in the capital account, but the income or the profits that we are getting from the investment should come in the current account. As I gave you the example in the previous video, that loan is a liability, so it should come in the capital account, but the interest that we are giving or the interest that we are getting should come in the current account because it is a regular payment, okay, and it is not creating the asset or the liability. Similarly here, investment should go into the capital account, but here we are not talking about the investment, we are talking about the income or the profits we are getting from the investment, so it should go into the concept. Thank you. you very much. If you have any query, you can mail us here or you can contact us through this number. Thank you very much.